Okay, what the heck happened to the stock of Chegg? Here's a small cap company with a $3 stock that started life as a renter of textbooks for college students. Smart business, since going into a provider of digital services for students, including everything from online homework help to assistance with picking colleges, getting scholarships, selecting courses, keeping the cost of college down. Lately, though, Chegg stock has been a house of pain. And that only got worse last night when the company reported a decidedly mixed quarter. Chegg's revenues came in below Wall Street's estimates, down 19% year over year, even as it did deliver a 2-cent earnings beat off of a 12-cent basis. Make matters worse, the guidance for next quarter and the full year was substantially weaker than expected, which is why the stock did get obliterated, down 35%. Chegg has been very effective at transforming itself into more of a digital student hub rather than just a textbook rental play. That doesn't seem to be helping the numbers. So did the market overreact with today's sell-off, or should we really be concerned here and maybe leave it alone? Let's dig deeper with Dan Rosenzweig, the chairman and CEO of Chegg, find out more about the quarter and his company's prospects. Mr. Rosenzweig, welcome back to Mad Money. Good to see you, sir.
Thanks for having me on.
Thank you. All right, Dan, you came here last year in August. Stock was at $7.40. Told a story that, a big transformation that sounded very good, and transformation seems to be apace. But the stock has been almost cut in half. So what I'm trying to figure out is usually the market can't be this wrong. The market seems to be caring more about no revenue growth and less about the transformation. So I know the market's not wrong, but what could the market not be seeing, say, a year from now?
Yeah, so first of all, thank you for having me on the show. I appreciate that. So going through a transformation of a company is extraordinarily difficult. Doing it in a public market is even more difficult, and doing it in very volatile times are even more difficult. However, the transition is actually underway and quite successful. The confusing parts of this, and they are confusing.
Right, because the e-book didn't go the way it was supposed to.
Right, exactly. So we articulated that 2016 on a GAAP basis would be down because we used to recognize 100% of the revenue from textbooks. Now we recognize a 20% commission from Ingram, which means it's cash flow positive as opposed to a cash user.
Right,
that was received very well.
Right, and what's interesting was there's the kind of switch between what kids were paying for books versus now.
That's right.
And that wasn't modeled.
No.
You couldn't model it.
You couldn't possibly know that. And then the second thing is, so we already said GAAP was going to be down, and we hoped everybody had known that.
I know.
Then the other thing is an industry trend, which is very bizarre, which is e-textbooks, which we're a reseller of, we would historically recognize 100% of their revenue. And for print, we recognize a 20% commission of the rental revenue. E-textbooks used to be growing at 60% a year. Right. They went to zero. In fact, they went down, which means our revenue recognition is less, but the unit volume is not less, because instead of taking an e-book, they're taking a print textbook. Why? The most popular textbook is Campbell Biology.
Right, you mentioned 20 bucks.
It's 20 bucks for a rental. It's 107 for an e-textbook. Why would any kid in their right mind do that? Because it's not better. So it's a top line issue, but not a volume issue, and not a business issue, and not a bottom line issue, because we've said the textbooks are going to be a flat business for us. Put them over here. Whether they're e-textbooks, print textbooks, and then the future of the business is Chegg Services, which grew at 38% last year and is growing at over 30% in 2016. So we're a growth company with profits.
Now, typically, a company that's cut in half like this would not be a growth company and would not have profits.
Right.
So when I look at this, it's almost as if that if you were to come public today and make the projections that you're making, people would buy the stock.
Yes.
But the stock has become very tainted, Dan,
yes,
because people feel like, well, why didn't you see certain things coming? And even though you're making this transformation, which I think is a very bullish transformation, actually one of the problems was you had more demand for one of your businesses than you could handle. But how do you explain to someone who did listen to you on the show, bought it at $7.40 and says, you know what, I just got crushed. He said it's a great quarter, but I got crushed.
Well, the business is actually better than what I described on the show that day. So if you take the textbooks out and say the future of Chegg is Chegg Services, we said in the middle of our range is going to grow about 30%. We said in the middle of our range, our EBITDA is going to triple.
Right.
Now, 2 years ago when we came public, we were losing $18 million. Then we lost $13 million. And then we made $5 this year, which was a huge thing. And we said at the middle of our range, it's going to triple next year. And we said the revenue's grown over 30%. So what I would say is, it's incredibly difficult for the analysts to understand our business. That is our responsibility. We have got to get better at explaining that. But the student love of Chegg is incredibly high. Your interns here use Chegg.
No, I know.
Our digital services, which were at zero
Daughters
revenue
use
4
Chegg.
years ago,
Daughters
which I
use Chegg.
appreciate. But our digital businesses were zero 4.5 years ago. In the middle of their range, they're going to be $120 million this year. Those were businesses that did not exist 4 years ago. So the future of Chegg is as big, if not bigger, than I said last time.
If that's the case, then why not right now say, listen, we have this much in the bank, and we're going to immediately start at least a buyback for X?
So it's a great question, and I can tell you that on a personal level on Thursday when the window opens, I plan to buy because this is ridiculous. I mean, we're trading at less than one times revenue.
Plan to buy 10,000 shares?
No, substantially more than that for me, okay? Because I just look at that. We have $89 million in cash. We have $30 million owed to us from Ingram. So that's $130 million cash against the $200 million market cap. It's so
it is hard to fathom. I have
Yes.
to tell you, when I did, obviously, I
You
did
did the
not
math.
want the stock to, you don't want the stock to
No.
crush. I mean, when I saw it, I said, well, hopefully people will see the EBITDA win, not the revenue loss. They'll understand that you're building, but the market can't comprehend it, Dan.
No,
It really
and
can't.
I think J.P. Morgan wrote something very smart, and it is what it is, which is they said people will not really start to understand this company until the middle of this year.
Right, and they said,
Because-
but they also said, listen, what concerned us, guidance, softer e-text demand, shifting the rentals may continue to have a magnified impact on revenue growth.
Right.
So in other words, you will not have good revenue growth next quarter either.
We will not have, well, it won't really affect next quarter so much, but that's true actually
Right,
because
that's
it's the
true.
first quarter. But it's the pile that we say to is supposed to be a break even, which builds our brand, gets our data. The Chegg services are not affected by this at all because the textbook revenue, we don't lose the customer.
Right.
They come in and get a
not
print.
lose the customer.
So we get the customer, and so the other businesses are growing at 30% or more.
Are you able to meet to the demand? Can you show that tutor demand that would really make us feel like that there was more to the service stream?
Can I show it? Sure.
Yes.
I mean, we couldn't meet 50% of the demand in Q4.
I know, but I'm saying in the next 3 months, can you
Yes.
monetize that?
So the thing, yes, the answer is yes. And the reason we can do that, and thank you for that question, is because the thing we learned about building a dynamic marketplace, it's not just having tutors. We had 11,000 tutors.
Right.
We thought that would be plenty. The difference is an on-demand marketplace. And by the way, on-demand learning is going to be huge.
Well, that's why you can tell that story.
Right.
You buy the stock, then people will say, why didn't I buy it at 3? But they also may say, I bought some at 7.
Yeah, and
Fair enough?
and I think that is very fair. And I think, look, we did not expect this kind of reaction today. If we did, I certainly wouldn't have booked your show. But because it's you, I would always come on.
Well, you're
right?
a fair man.
And what I would say to you is on the tutor side, we have something called an OSR, which is an opportunity supply number, which is within 5 minutes of a student requesting a tutor, we can give them one. And we're not going to drive demand past that. And the first part of this year, we think we have solved that issue.
All right, we're going to be looking for that, Dan.
I look forward to it.
All right, that's Dan Rosenzweig, President and CEO of Chegg and CHGG. Some consolation, the fact that it was down a lot. The guy's here. He showed. Mad Money's back. Right. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.